Hello and welcome to the latest edition of the Jerroms Miller Tax Hour. I'm your host, Nick Wright, Director of Jerroms Miller, and today we are talking about employee ownership on Employee Ownership Day. I'm really pleased to introduce two guests of mine who are industry experts. I think I can easily call you both that. Firstly, we've got Campbell McDonald, CEO of think tank Ownership at Work. Took me about 10 seconds to realise on the phone when I was first introduced to Campbell that Campbell would be perfect for this because not only does he run employee ownership at work, but Campbell is also independent trustee of various businesses and also does a huge amount of policy in the sector work as well. So thank you very much for joining me, Campbell.
Pleasure.
And I'm joined by Neil Palmer of Fieldfisher. And Neil has worked on, I don't know how many, you've probably lost count how many EOT transactions you've worked on, but even before the employee ownership trust model was announced in Finance Act 14. So thank you for joining me as well.
Again, pleasure.
So I know this is the tax hour, and generally we talk lots of technical tax things, but really today I thought I really want to push what employee ownership really means, what it means to the government. Why on earth are we getting a entirely tax-free sale? What does that achieve? And what does it mean for businesses? And what do businesses need to understand from us as advisors, not just in the transaction of how do we sell them into an EOT, in terms of the tax conditions and the legals, but also what the businesses need to understand to make sure that the business is successful afterwards. So perhaps to start with, Campbell, could you perhaps tell us a bit about Ownership at Work and what you do?
Yeah, happy to. Ownership at Work is an independent charitable think tank. It has not been around for very long in its current form, and it came about 4 years ago, really to address a gap in the evidence base for the sector. Yep. And we have just completed and published at the end of last year something called the EO Knowledge Programme. That was a 2-year research project to create a treasury quality baseline to demonstrate the economic, social and environmental impact of the model, and to try to understand what happens in a business after you introduce broad-based employee ownership that may or may not support that business to succeed in various ways. And we compared about 10% of the employee-owned sector in the UK to a cohort of businesses twice the size that were matched non-employee-owned businesses. And we got some really powerful headlines from that. I mean, the big one, which is sort of quite eye-catching, is that there was between an 8 to 12% productivity uplift at the level of each employee in employee-owned businesses. Now, even allowing for a little optimism bias, if you think about the generational doldrums that the country has been in and the constant search for solutions to address productivity, that's a kind of slap you in the face sort of stat. But look, there's more to it than that. If you can give me half a minute, I mean, we found that typically EO businesses were more profitable, they were employing more people, that they were, it won't be surprising, the maths obviously stacks, that at the level of contribution to UK PLC, they outperform non-employee-owned businesses in line with that productivity number. But then look, why is it happening? What you get is a lot of evidence that across levels of investment in health and well-being, in amount of bonus or dividend shared with employees, levels of kind of minimum or living wage, right across the piece, we see employees have a kind of better deal on the table in an employee-owned business. And that seems to be translating in a above 80% motivational uplift post the introduction of employee ownership.
80% motivational uplift.
Sorry. So just to be clear on that, it is not that it was 0 and then it goes up by 80%. It is that the stats from those businesses are reporting that their motivation and job satisfaction levels have gone up, and those levels are typically coming in at about 83% or there and above, right? So you've got something which seems to be showing that it is producing benefits at the level of the firm and benefits at the level of the individual employee. And those two things together are absolutely fundamental to understanding why I think this is an incredibly powerful model. And final point from me, they're reflected in the tax reliefs, right?
Yeah.
So the fact that you have a CGT relief up front, which is designed to bring a selling owner to the table, but you then have this income tax-free amount up to £3,600 for every employee who is paid a dividend post-transaction, it was designed in from the off that there would be a benefit for the firm, but also for the individuals within it.
That makes me think of one point that we, as within Jerroms Miller, when we do seminars and webinars on this, we talk a lot about the consultation document that we did. Well, many people responded to, including ICAW, the EOA did as well. I think I was involved in a couple of discussions with them when they were trying to get a variety of thoughts from advisors and business owners on the responses. And one of the things that always jumps out at me when we're talking about, are we expecting any changes in the legislation, because nothing's happened for 10 years since it was introduced, the fact that they've got a £3,600 income tax-free bonus, which is really nice, especially for perhaps the lower level employees, but that hasn't changed in 10 years. So one of my first, I guess, not to be negative about things, but one of my first thoughts is that really we should be pushing that further. We should be doing more for the employees in terms of what benefits they get out of it.
I completely agree with you. Very interesting to see the Lib Dem manifesto ahead of this general election be explicit about wanting to sort of do more to empower employees themselves in businesses to request the option to have an EOT, employee ownership trust, on the table. So look, I mean, yes, simple yes.
Neil, should we talk a bit about, because we were talking earlier before we came on about the idea that a lot of advisory is the transactional side. So it's kind of the first step is, okay, we need to get someone into employee-owned businesses. And yes, I want to concentrate on sort of the long term so that advisors and business owners understand a bit more about driving the employee model more. But in terms of selling into an EOT, is there any restriction on sectors that you see, or do you I know we've talked about that you've seen quite a lot of architects, for instance.
Great question. I mean, I think the first point I want to emphasize is that employee ownership is really two things. It's a succession strategy or exit strategy, and it's also a very good business model. And Campbell's explained the benefits which they found from their extensive research into employee ownership. So what you have is a way in which founders of businesses can divest ownership, share ownership a bit more, and get value. But also put the business into a really good structure. And I mean, to answer your question, employee ownership can apply well to any type of business. I mean, various factors have led more professional services firms at the outset to pursue this route, particularly architects. I think there are particular things about how architects are structured and the architects market is like, which leads them towards employee ownership. But, the breakdown on the Employee Ownership Association website shows that there are a diversity of businesses which like employee ownership. I think we'd probably say that, capital intensive firms, it may suit those less than professional services firms, which have, low investment requirements. But the stats show that manufacturing businesses are doing this as well. Yeah,
I know I've worked on manufacturing businesses, and in terms of professional services, I know law firms as well. There's a number of law firms that I've worked with that are also employee owned. So, from what I've seen, there is anybody. If and we'll come on to a bit more about what's actually needed for an employee owned business to run. But I mean, certainly the tax legislation doesn't restrict us, which is fantastic. And I think the stats you were talking about was something like 39%, I think, is professional services. So.
I mean, one point to mention that the sort of the regulators of certain professional services businesses may create extra hurdles. I mean, law firms can become employee owned. You have to apply to the regulator, the SRA. Accountancy firms, it's a bit more challenging.
Yeah, I'm not sure I know any accountancy firms that are.
Yeah, I mean, it's something which hasn't really been taken up, and there are some regulatory hurdles. But we found quite a lot of businesses in the financial services sector are very keen to become employee owned.
Yeah.
They, of course, are regulated by the Financial Conduct Authority, and that creates another layer of complexity in applying for, change of control consent.
Yeah, because I've done quite a lot with FCA regulated businesses, not just employee ownership, and the FCA stage is always a bit. Is always kind of one of the key parts to actually navigating this.
I mean, oddly, I really enjoy that stage because there is a school of thought that employee ownership is quite an internal type of transaction. But if you are regulated and you have to apply to a regulator, the FCA will examine your application in a great deal of detail. They'll explore all the numbers and the finances and the cash flows, and they will really test you. And I quite enjoy that process because you have to put forward a good case and put forward the best case.
I think the fact that 39% of professional services have taken up employee ownership feels quite telling, but I think more and more businesses of all sectors, and I think a lot of that is advisors understanding EOTs more. I mean, probably I would say 2 or 3 years ago, there weren't that many advisors doing EOT work. And so more advisors, whether or not they've just started to dabble a bit, but within Jerroms Miller, we support other advisors. So they might not have done an EOT before and just ask us to kind of give them a bit of support whilst they do all the work. And it's good that there is a lot more knowledge out there, I think, than there used to be. I think I read in tax. Yeah. Go on, tell me what you're thinking.
Well, look, I agree. I'm a big supporter of the model.
Yeah.
I think that the impact of the tax relief DOT model has been fantastic. Right. 10 years ago, there were maybe a little over 300 broad-based employee-owned businesses in the UK. We're now looking at probably, announced today, but better part of 2,000.
Yeah.
So, and most of that growth has been driven by the EOT, and it's happened in the last 3 or 4 years. So inevitably, as a part of that, yes, absolutely, there are more professional advisors who are supporting transactions to happen. And we might get onto this, though. But what I would also say is that I try to encourage all the professional advisors I ever partner with when I'm supporting these kind of deals to think of it, and I encourage the businesses themselves to think of it as a transition, rather than a transaction.
I used the word transaction before, didn't I?
So the transition is something that takes place over a little period of time. These are businesses; they're organic things as much as anything else. They're full of people, and you are going to, in the very least, introduce something new into the governance and the way decisions are made. And people in the business are going to know that this change has happened. Yeah. So even if you withhold as much as possible, I would ever advise you could do that.
Yeah.
There are these two things. So there is something new there in the mix. And the nature of the transactional support is quite often that you do the bit that gets them to that point, and then you sort of hand over the keys and you go, look, good luck, and you step away. So there's no judgment involved in my next observation. But what I am increasingly finding as somebody who gets parachuted into businesses that are 1, 2, 3, 5 years into their EO journey is that more businesses are struggling with some aspects of how to get this model to work for them. They were promised some of those benefits we talked about on the way in, some of the things that the data shows. Now, lots of businesses experience that, but some don't.
Yeah.
And actually, there's a bit of support here around how does that new governance work? How do you make sure it doesn't clash? It doesn't create disruption. It doesn't create business discontinuity. And then how do you over time help the business actually get those benefits that they sort of think were dangled kind of at the point of transaction?
Yeah.
So there's quite a lot of extra knowledge, I would say, I hope, starts to kind of make its way out to employee-owned businesses, to leadership teams, and to advisors.
Yeah, but that's something that really, when you're, as you to convert into your term, transition into an employee-owned business, you kind of need that information straight away. You can't 2 or 3 years down the line. Ideally, you wouldn't get to the point where you need someone to come in and help them turn things around.
My view at this point is that that kind of additional element doesn't need to clash with or rub up against the transactional elements. It can be done in a wholly complementary way, and it acts essentially as a insurance policy to make sure the business doesn't struggle in those early years to make this work.
I mean, when we're advising, I'm going to call it the transaction is the sale into the EO, and then the transition is the sort of the medium term, I guess, if you like.
So I might challenge your definition of that. I would say that the transition process is one that begins when an owner decides this could be right for my business, and it ends when the business is comfortable with the model and there's a good rhythm and it's seeing some of those performance benefits. And the transaction can happen almost wherever you want in between those 2 points, early, mid, late. But I think so I don't want people to be like, oh, we get to transaction and then the transition is what comes next. Because that was sort of your previous point was, actually we should be helping people to think about it that way before they hit transaction.
I do think when I'm advising, I don't know if you'll agree, Neil, but when a client comes to me, there's normally two scenarios. One, they've heard about EOTs because of a potential tax saving, so they want the tax saving, to which we then end up in a conversation of, okay, is that the right business model? Is an MBO or is a third party sale actually more suitable? How are you going to run this business if you're gone and retired? And then there's the others who it's a genuine, I'm just looking at succession planning. And that's, as you say, that's really where the transition starts of, do you understand what employee ownership is? Plus you've got a massive added benefit that you could sell for and pay no tax. So
I have another word. It's an evolution. And that both suggests what Campbell's saying, but it also, I think, shows that you can introduce more things into the process as things go by. For example, you could start with appointing employee trustees and then 2 years in, start an election process. I think I'm very keen that founders and business owners don't try and do everything
at once.
Yeah. It's better to go slowly and do it really well than, go quick. And get to that stage where Campbell's parachuted in. So
hopefully not.
I'm keen that this is to emphasise. This is, to me, an evolution where you gradually introduce this, and it is a long-term thing. And that Campbell's point, I entirely agree with. That you have to look at this as a long-term thing.
Yeah.
I get involved in the structuring, the advice, the implementation. But the real work starts when you hand over the keys or whatever it is. And that's when the real work is done by management, by the founders, to make it really happen. Because this is a thing that's with you for a long time.
Yep.
It's not just for Christmas.
Yeah. I think talking about the transition, the evolution, I think one of those stages is, okay, we're selling into the EOT. Most EOTs are funded via deferred consideration. Typically, you can get funding and some banks will lend. And there are some banks, there's 2 I know of that will lend to a trust, but more banks prefer to lend to the trading company. And there's loads of funding issues around that. I'm not sure whether we want to go into those or not. But at what point do the employees really see the benefit? Because obviously, to begin with, we're trying to pay the previous owners, the vendors, off. So when you've done your research, Campbell, are you seeing the increased motivational stuff straight away? Does it take a few years to come in? Sort of at what point during our evolution do we see those changes?
So can I give you two answers?
Of course.
give me a minute. So look, the first answer specifically to your question is unhelpfully, it's completely varied. Right? Some businesses get an early bounce.
Yeah.
Quite often those are businesses where the benefits of employee ownership are sold hard to the employee group at the point where it's announced, it's introduced. You're going to get this. You know, we're going to share business information with you, like owners. We're going to, you're going to have influence over key decisions. You're going to get to share in profit and reward and so on. The problem is people, go away and they go all sorts of places with what that means.
Yeah.
And if you don't meet those expectations, then within a couple of years, management teams are walking people back down that hill to say, no, well, we didn't mean that. We didn't mean that we were going to have a discussion every 2 weeks and you were going to be involved in every major board decision. Okay. And so suddenly what should have been a positive can become a negative quite quickly, which seems a real shame. In some businesses, they ensure when they're doing the modeling for the valuation from the valuation for the deferred consideration period, they leave enough headroom enough margin that they can make a dividend payment that has a tax relief applied from year one.
Yeah,
I'd say in those businesses, you see some of those, changes in behavior and expectation amongst the employee group switch on from the start. I've seen other businesses where they absolutely rank payment of deferred consideration above absolutely everything else in their sequence of retentions at the end of each year, and nothing is paid for 5 years, 7 years. And you have employees who are sat and told that they're owners and told that they're going to share in some benefits of ownership for, like 7 years. And you can imagine they're pretty cynical by the time they get to the end of 2-3 years into that period. So the first answer is it's super varied.
Yeah.
Right. I'm going to pause for a minute, actually, because I have a second piece, which I want to do, which probably takes a minute or two, because I want to really kind of just unpack the mechanics of how the model works.
Yeah.
Because by understanding that, I think your audience will understand better what the opportunity is for the people that they're sat around the table with.
Yeah.
But I'm going to pause for a minute because, Neil may want to come in on what I said on the...
I mean, all I would say is the benefits of employee ownership don't come automatically.
No.
That you have to work at them. You have to put the effort in. You don't just get happy, motivated staff. You have to work at that. And the key message that I really want to get across is, for business owners, particularly when we're advising them, is you have to get involved. You have to make it work. It doesn't just... You don't put it in a box. You don't put 10p in the meter. I
agree, and I think what the people who come to me and say I'm looking to retire, once I've got my money, I'm off on a yacht in the Bahamas. It's the biggest issue we have is, okay, well, that's fine. You can go and do that, but you need somebody who's going to drive this business going forward. And as you say, we talk about driving business going forward, whether that's increasing the motivation or as a bare minimum delivering their deferred profits, which they think they're going to get in the future. So, I agree. I think nothing's going to happen overnight on employee ownership, even though you might get your tax break on day one kind of thing.
What you just said is absolutely on the money, right? So this model, even before the introduction of the EOT 10 years ago, was sold by advisors to business owners who are looking at an exit or a sale point off the back of a list of benefits, right? And Neil will be absolutely familiar and intimate with that list of benefits, as I'm sure you will be too, Nick, right? And to rehearse it super quickly, it is some version of you make everyone an owner, they become incredibly motivated. It switches on all sorts of levels of discretionary effort, attention to cost. It's easier to recruit and retain people. You get better quality ideas coming through. Absenteeism goes down. top line goes up, bottom line goes up, the business is more resilient, and everyone skips into work with a smile on their face every morning. It's some version of that, right? And as you say, EO is not a silver bullet. It doesn't guarantee any of those things. The point I want to make is all of those benefits are at the level of the firm. But there's some really simple maths here. You only switch those on if enough people, individuals in the business, feel genuinely excited that there is something in it for them, and it changes something about how they behave in their jobs. And you need enough people to feel that way in order to switch on those benefits at the level of the firm.
Yeah.
And so what I do when I'm working, and I should say, by the way, sorry, because I was introduced with the think tank hat on, but I do a lot of kind of, transaction transition support work, largely through something called Eternal Business Consultancy. And I just want to be clear because the think tank is charitable, so I don't want to kind of cross those streams if that's okay. But look, the bit I try to show people is if you're an individual, you see the benefits of employee ownership as an entirely differently expressed list, right? So it's essentially, I get to share a bit more cash in my back pocket at the end of the year. My business is going to treat me like a grown-up and explain the numbers to me and tell me how my business works and where it makes money. And it's going to help me understand those numbers. It might give me more autonomy in role. It might spend more, and certainly our knowledge program data says that EO businesses spend more on supporting health and well-being. They spend more on supporting employees through cost of living. They invest more per business in training and developing employees. So actually, these are all things which as an individual, I think, okay, I could benefit from that.
Yeah.
And once the business is employee owned and employee voice is clearly, explicitly factored into how decisions are made, you can attribute those benefits to the model. Yeah. But the point being that, I've sat in the room with business owners as they make their announcements and they tell people there's going to be all these benefits. You're all going to become much more motivated and the business is going to do really well. And you just see people sitting there going, I think you just told me I'm going to become more motivated. I don't think that's how motivation works, right? And the point being that by getting the business to think of it in those terms actually changes the way that you are talking to people about what it means to be owners. And when I get parachuted in, the most common thing I find as to why it's not working is because different groups, trustees, wider employee group, board, exco, exiting owners, all have different expectations about what those benefits are that they're going to get.
Yeah. I mean, one thing actually, Neil, you touched on talking about the employee trustees. From a tax perspective, there is nothing that says who the trustees should be. I mean, one of the consultation things was, well, should the vendors be able to control the board of trustees when we're suggesting that there should be a change of control of the shares. So when we're talking about setting an employee ownership trust up, having somebody who is having a board of trustees that includes employee representatives is clearly going to be one of the most essential things to deliver some of those benefits you're just talking about.
I mean, look,
aimed at either of you.
Well, look, I mean, yes, you would think so, but I'm actually a horrible pragmatist on this point, right? I agree with Neil. Every business is going to set its own flavor of EO. Go slowly. Not every employee is going to be ready, to kind of take on some of the pressure and the expectation responsibility. Yeah. And that is not a dismissive comment. My point is merely, if you are going to put employees who don't have experience in those roles into those roles, then please God, support them, give them coaching, give them training, and recognize that asymmetry, right? But the key point here, let me put this a different way. There are two critical decisions that dictate whether or not employee ownership gives you those firm level benefits. So the first is an owner decides to sell, changes the deal on the table for employees.
Yep.
They get a right to share an information, influence, and reward, and there's some expectations on behaviors. That on its own does not guarantee you outcomes. There is a second critical decision point, which is where the leadership of the business decide how to operationalize employee ownership, how to bring it to life, if to bring it to life. Right? You don't have to. But if you want to see any of those benefits associated with it, you got to do it, which is a different way of saying exactly what Neil said, which is, that leadership team has to recognize that sits with them. It's not outsourced to trustees. It's their choices. They have their hands on the levers that will deliver those benefits. And reporting to shareholders as you would do to another type of investor or shareholder is a very healthy discipline. What do employees prioritize as benefits of ownership, and can you demonstrate to them on a yearly basis you're delivering it? You start thinking in that way, then I think you've got a really good chance of seeing the real benefits of the model.
Well, so when I was talking about someone representing the employees, I was more thinking not necessarily suddenly all the employees suddenly have a decision in terms of what votes are going to be done on the board and things, but more someone mid-tier or high tier that would kind of have a voice for those people who maybe didn't think they had a voice under the previous ownership structure. So whilst the tax doesn't, or the tax legislation doesn't dictate at all what's required, clearly there's some pretty, from your perspective in terms of delivering these benefits, there's some good advice to be had that certainly don't just have the vendors on the board and have a good mix.
I mean, we would never recommend that. No. Our practice has always been that a trustee board should have a majority of people not connected with the sale. You might have two of the founders or vendors. You'd have an independent chair. You might have two employee representatives. But just putting employees on the board doesn't make it effective and wonderful.
No.
It's something you should work, and you could have a much more effective board without the employees. But what we want is employees involved and having a voice. That's one of the ways of doing it. I mean, I do think the trust board plays an essential role. It is ultimately there to police how the business operates. It's not meant to intervene all the time, but its duty is to look out for the staff, ensure that they're being looked after, and to make the operating board account for what they're doing.
And I think so. Just to be clear on kind of the separate roles, we have a board of trustees who are the trustees of a trust who own the majority of the shares. Sometimes it's 100%. The tax rules just say if you want relief, you have to sell control. So 51% is your minimum, basically. But there's still a board of directors running the business day to day, isn't there? So in theory, if you've got vendors who aren't in the day-to-day management of the firm before it sells, there could in theory be no change. I'm assuming that's not going to deliver the benefits we actually want, because we're saying there's no change to the business and the other employees don't really get to see that motivational change.
So I think there's a point worth making here, because Neil, you'll have experienced this too when you sit in the room with some businesses, and a lot of the businesses who approach this model are really excellent businesses. They are already doing a lot to support employees, to share information, to involve employees in decision making, probably to share reward in some kind, right? So they're quite often doing a lot of that already. So the level of change may not be huge at all. The point is, though, that let me give you an illustration. I have sat as an independent trustee. I have sat at the operating board. So have the operating board in the room with the trustees in a number of firms where it's quite often the FD. I don't know why it's quite often the FD, but it's quite often the FD who's the one who will sit there and say, well, I'm not seeing any evidence that people are acting like owners. We were told they would act like owners, and it's not there in my numbers. Where is it? We were promised this. And quite often what you end up saying is, well, look, what have you done then to make them feel like owners. What have you done to bring that to life for them? And there's some pretty simple areas, some simple mechanics, where you can do that, not just profit share. And the answer is usually mixed. There's a second really critical point here, which is the deal on the table is the quid pro quo, if you like, is we treat you like owners by sharing information, influence, and reward as a basic. In return, we expect you to think like an owner and act like an owner.
Yeah.
Most people do not have the first clue what that means. I mean, well, honestly, right? Like for younger generations, half of them haven't had a chance to own anything at this point, right? So why management teams expect people to know what that means? And you get all these lovely platitudes about, go the extra mile, go over and above. Most people think they already do that. Deluded or not, they think that that's what they already do in their jobs. So the final bit of this is you've got to be specific. Every business, what are the behaviors in line with your business plan that you want to see more of from people as owners? Because if you don't tell people, then again, you're not going to switch it on. You ain't going to see it.
Yeah. So I think there's a huge amount of information available out there, and I think ownership at work, employee ownership association, those types of associations are really driving that. And I think for us as advisors, and for me as a tax advisor, you become a more well-rounded advisor in terms of talking to someone about succession planning. Because all I can do when a client comes in to me and says I'm looking at succession planning is tell them a bit about my personal experience based on the transactions I've done, but I'm not an authority on, running an EO business. So all I can then say is, okay, this is what it means. You need to be aware of sort of the consequences of it. And then it's really up to them to decide, is this a model that's going to work for them? And places like the Employee Ownership Association, I know they do webinars, they do loads of stuff, don't they? And I think that's kind of one of the key messages to people is understand before you go into it. This is not just a tax-free sale, because that's what half my EO life is explaining.
If there's anything I've learned, Nick, in the years I've been doing this is, and it's unusual for me as a lawyer to be humble, is there is so much more to this transition process than I expected. And I have a diagram which I call the EO universe, which sets out the main areas of EO, and the implementation bit, the bit I do, is one of them.
Yep.
And there are 5 others. And it's culture, it's about stakeholders, it's about financial planning, and really to get a holistic set of advice together, you really have to think about all of these issues, because it is not a set of legal documents or trust documents and a bit of tax advice. It's setting up a whole new model with a culture and a new way of doing things, and it has its own governance structures. But there's a whole series of things, and one of the things I know Graham Nuttall, my colleague, is very interested in is this sort of ethos feeling that EO businesses should be doing good things, and there is a good work principle, and you should think about purpose and things like that, and what stakeholders want. So there is a whole greater world to this, which I think all advisors who have clients coming in and saying, I'm interested in this, should be at least aware of. And I would regularly, I'm always referring potential clients to other types of advisors just to say, you should think about financial modeling. You should think about engaging with staff. You should think about culture. You should think about wealth management. All of these things, because I think it's, it takes more than it's a village to raise a child, or whatever the saying is. My main takeaway from this is there is a lot to this process, this transition process, and it's not just about the legals.
Now, I need to see that your EO universe diagram. I'm picturing this amazing thing of what businesses need to understand, and I completely agree. I think that's my bit of, or when I'm coming from a tax side, my bit of the project is a tiny bit.
Yeah.
I mean, obviously to the vendors, it's a nice tax savings, but it's tiny.
I sometimes call it the iceberg principle, but it has sort of unfortunate connotations. But the bit I'm involved with is often the tip.
Yeah.
The bit below the surface is, you know, a lot of that happens after, but it's the thing that has a lot of meaning and is where the hard work is.
Yeah. I mean, as an advisor who probably 95% of what I've done on EO is the selling into the trust. It's sometimes you think, okay, it's nice to know how those businesses has been affected, and as you say, really understanding how much that is driving that business going forward. Because you know, if you've got a £10 million business today that they sell into, you pay your £10 million off, everybody's happy. Surely that business is going to, the value of that business is going to go up. And we were talking before, weren't we, when we were saying, yes, we can sell into an EO and you'll have once you've paid the vendors off, what we're going to do with this cash. So let's take an example of £10 million and we're paying someone off over 10 years. So £1 million a year after 10 years, assuming nothing's changed, we're still generating £1 million a year. What do we do with it? Does that mean we reinvest it? Do we grow the business that way? Do we pay higher salaries? Because, as we said, if you suddenly give everybody a share of the whole £1 million, do they all feel like they need to come to work every day, kind of thing? So, kind of what's the picture in terms of financially once we've dealt with funding the vendors? Is it all gone back into the business? Do EO businesses sit on cash and look to grow in other ways? Or
I mean, we're talking about this because you know, the jump in EO businesses started in 2014, and a lot of them have gone through their payment schedule and are now so some advisors call it Freedom Day, but they've paid off the consideration, and then they have to address, you know, how they share profits, and that really falls on the operating board in consultation with the EOT trustee to make decisions which are right for the business. And there might be a need for expenditure. There may be ways in which the staff can be benefiting, you know, rather than being given direct financial payments by better facilities and so forth. I mean, and not to duck the question, it is something for each company.
I was going to say
what's best, and you might see a mixture of financial benefits, you know, extra contributions and pension contributions, better facilities, and so forth. I mean, in a way, it's a nice problem to have, and a lot of businesses will be getting to that stage now. But I think it's an area, I don't know, Campbell, you've come across which is being explored more now as more businesses come out of that payment profile.
Yeah, I think we caught some businesses in the cohort that we were involved in the knowledge program who had gone past Freedom Day, and you know, the not sufficient numbers that we could make statistically significant claims. But what we saw was that those businesses shared more cash with employees because there was more cash in the business to do.
Yeah.
But look, I guess I'd make a general observation here, right? Which is, let me put it this way, put it differently. I have tried in a number of firms to encourage the management team to ask the beneficiaries of the trust, i.e. the employees, what they see as the most important benefits of ownership.
Yeah.
That's a really simple thing to do. And you probably can't do it blind, but you provide people with a list, that individual's list that I kind of gave before, right? So profit share, training, you know, health and well-being, a list of things that I say, right, which of these are relevant to you at all? And then, look, no business can afford to do every single one of these to the nth degree. Yeah. So what are the top 2 or 3 that are most important? So rank them.
Yeah.
And then you have data. So in every other area of a well-run business, a management team would have data-informed decision-making, right? But most management teams, when it comes to what do we do for people as owners, kind of lick their fingers, stick it in there, and go, oh, we think this is what people will want, right?
Yeah.
But I mean, I've seen businesses where they've had a great year, taking everyone away on like kind of a trip because they've had a great year, and then people are grumbling, oh, well, we didn't ask for that. We'd rather have had the money over here, right? Like, so, point being, if you've actually got some data on what your employees are telling you they value most as the benefits of ownership, well, then you can make informed choices about, as you say, when you're sat at the end of the year as a board, operating board, and you're going, okay, well, this is how much surplus we've got. These are the debts we need to pay. This is what we need for working cap. Yeah. This is where we need to make some investments. This is what's left. What do we do with it? Well, you've got something on which to base your choices. But to your original question, Nick, these are good, smart, sensible businesses. There's a reason they're steady performance. There's a reason they're making £1 million a year. Right? So if that's the case, then they're going to be making smart choices to invest in the future. And don't forget, the trustees ultimately are responsible for protecting the value of the shareholding over time. That majority shareholder role in law is a part of why they're there. So they're going to want smart choices, not just clean out all the cash and leave the business vulnerable, right? So
I just wanted to touch on a couple of things that have kind of come about more recently. One is about how we account for some of these, which is, I don't know why it's suddenly now that actually all of these questions are coming out, maybe just because there's more employee-owned businesses, but quite a common structure is that the trustees are actually directors of a trustee company, so that there's some limited liability protection for them. And I get a lot of questions, and in fact, in the last month, I've probably had 3 or 4 questions about what does the trust co actually show on its balance sheet. My answer is nothing. They don't actually have, the trust company doesn't have anything. We've got trustees. The trust company is a corporate trustee of a discretionary trust. The discretionary trust has an investment of the shares in the company. It has probably debt due to the vendors or possibly a bank. So everything sits at that trust. The trust company is dormant. I've not yet come across a trust company that has anything in it other than just some directors who are. So I thought I'd just as part of this, just clear that. That's a question I've had quite a bit, and I can't yet think of an example where the trust company itself has anything in it.
All I would say, Nick, is you've given an almost perfect answer to that issue as far as I'm concerned.
Perfect.
The ownership of the shares sits in the trust.
Yeah.
The trustee company acts as a trustee and operates the trust on behalf of the beneficiaries.
The other thing, which is not really a tax problem, but how we structure the ownership. When I give seminars and webinars on EOTs, I have this really weird looking structure, which has it has a trust co at the top, which owns or is the trustee of the EOT. It then has the EOT owning, let's just say it's just one trade co. Then it's got below trade co, trust co again. So you've got this circular ownership. And I think it was in Graham Nuttall's report that this might have been touched on as to why there are some benefits. It's entirely not tax related, I don't think. But having the trust co generally, and it seems to be fairly standard advice from other lawyers that I've seen put EOTs in place, that trade co owns trust co, which is a bit weird, isn't it? To think that, because someone has to own trust co. Trust co can either be limited by guarantee or can be limited by shares, in which case the shares are owned by the trade co. Have you come across any other reasons why that seems to be the standard model that is how they're being set up, or is it just this has come about from it's just the way it's been done for so long? Because I've got some negative tax points for that, which is if you want to put an EMI scheme in place. So if you've got a manager who you want to say, well, we don't want him to just walk off because he's not getting direct share ownership, so we'll give him 10% EMI options or something. If you've got the trust co at the bottom, limited by guarantee, you can't do EMI because EMI says you have to have qualifying subs, which is limited by shares. So that's a trap I've seen people falling into. I don't think it's difficult to change, but I'm also not sure what the purpose of having trust co at the bottom is, or whether it matters really.
I think this could be a podcast in its own.
It could, couldn't it?
Right. All I can say is we whenever we advise clients on this, we set up a trust co as a company limited by guarantee, which sits at the top.
Yeah.
I have seen it done the other way. There may be some accounting issues with that, but as a lawyer, I wouldn't want to comment any further on
I won't hold you to anything, don't worry.
That could be the next technical podcast on.
But it is interesting that seems to be a reasonably standard model. I'm not sure where it kind of came from historically, but at the same time, other advisors should be aware that if you've got a company limited by guarantee as a subsidiary, then EMI options might be problematic. So I thought I'd throw that out there as a little finishing point. I think that's pretty much all we've got time for, but this has, I think, been a fascinating conversation. So thank you so much, both of you, for joining me. I think for me, the key message is there's for some people say 5 tax conditions, they are what they are, and go and listen to one of our webinars and seminars if you want to know a bit more about that. But really, everybody understanding employee ownership a bit more, and hopefully this podcast has gone some way to helping with that, I think can only be good for the sector. So thank you very much, both of you.
Thank you.
Thank you.